Good afternoon, everybody. My name is Patrick Adumoko. I am the Executive Secretary and Chief Executive of the Association of Corporate Treasurers of Nigeria. On behalf of the Governing Council and the members of the Actn, I would like to welcome all of you to this webinar, which is being hosted by the Actn as part of its objective of regularly holding programs and events for the benefit of corporate treasurers. We expect that you will have patience in the course of this discussion, and we want to advise that you kindly write all your questions in the Q&A button, so that during the question and answer session, your questions will be administered appropriately. Well, at this point, I wish to invite the president of the association, Mr. Zil Akariwe, to make his opening remarks and thereafter introduce our guest speaker for today. Thank you very much.
Okay, thank you very much, Patrick, and good afternoon, everybody. The Governing Council and the members of the Association of Corporate Treasurers, I wish to welcome you all to this webinar themed The Economic Outlook for Nigeria. And with everything that has happened, I'm pretty sure that we know that whatever outlook we had in January is pretty much thrown out of the window with COVID. I think a lot of things that are going on right now, economically, excluding COVID, did not take many people by surprise. But I think COVID has managed to accelerate a lot of the things that we were expecting, maybe Q4 early or early next year. You would agree with me that the discussion on the future of Nigerian economy in the short and the long term at this time is quite apt, given all the uncertainties faced by the global economies as everyone continues to battle with the impact of dealing with the spread of the coronavirus. One of the direct effects of the pandemic on the Nigerian economy is the restrictions we had, interstate restrictions and national restrictions, and lack of productivity in that period. And of course, we know that the impact on GDP, we still wait to see a lot of the numbers, but we all know that the impact is for Q2 especially is going to be quite significant. We're delighted to have Razia Khan. I mean, as far as in our circles, we say she's the central bank governor for Africa. And I think everybody in any finance or economics related role in Africa will be very, very abreast with a lot of her writings, a lot of her seminars, and her apt analysis of countries in Africa. And so we're happy she's agreed to join us today. And we just hope that what she tells us will be able to find a way to implement it so that going forward, the impact on our economies is not as dire as we expect. The association has continued to strive towards organizing programs and events of this kind, as well as encourage all our members on the need to implement international best practices in their treasury functions, especially in this period of prolonged uncertainties. And sequel to the outcome of a recent survey that we carried out on the impact of the lockdown on corporate treasury function, the association has encouraged corporate treasurers to ensure that they consider implementing a documented treasury protocol and process. I know a lot of treasuries have the protocols and processes, but don't have them documented. It's very important that we have this documented so that we can implement these into treasury management solutions, and where possible, and it's highly encouraged, implement the integration of the individual corporate treasury management with their banks through SWIFT, the network for effective corporate treasury functions. It's therefore our hope that our members will consider these processes and implement them based on the enormous benefits that we would have seen over the last couple of months that they bring. So on this note, I wish us all a very fruitful discussion. And once again, Welcome to the webinar. For those who don't know Razia, Razia is the head of research for Africa and the Middle East with Standard Chartered Bank, and she's had more than 2 decades of experience covering the emerging and frontier markets. She's a very well-known commentator on the region and provides regular updates to central banks, funds, and other institutional investors and corporates in the region. She's currently serving on the advisory board of the Royal Africa Society and is a trustee of Save the Children Africa. She has previously served on WEF's Global Future Council on Migration and the Global Agenda on Poverty and Economic Development. She was named one of the 100 most influential Africans in 2015 and one of the 100 Africa economic leaders by the Institute Trousseau in 2017. So everybody, please let's welcome Razia, and we're all taking notes and we're all hoping to gain a lot as we normally do. Razia.
Thank you very much, Zeal. And first of all, I'd like to offer my thanks to the Association of Corporate Treasurers for this opportunity to present to you today. I wish we could be meeting properly in less difficult times, but it seems fitting that the fact that we've all been forced to move on to a Zoom conferencing function is telling about the state of the global economy today. It has deep implications, as we know, for economic activity and equally deep implications for oil demand. This, of course, is central to the challenges that Nigeria is facing at this point in time. Now, the presentation that I've prepared for you today, and I do not have slides for you today over the Zoom conference, but what we hope to do in time is make a slide pack available to everyone who has dialed in. I'm going to make it easier in terms of just going with the commentary on some of the key themes that are occupying us. I will look first of all at what is happening to the global economy, the outlook for the US dollar, what this means for eventual flows or not into emerging markets. I will look at the outlook for oil markets and look at the implications for the Nigerian economy. First of all, the global economy. We all know that we are in a very difficult place at this point in time. Not so long ago, for many of us working through the global financial crisis, at the time we were told it was a once in 50-year type event. Very few of us would have anticipated, even at the start of this year, that we would be looking at anything like the severity of the challenge that faces us now. We now know, with the benefits of, if benefit is the right word, having observed the lockdowns across China, different Asian markets, the US, Europe in late Q1, early Q2, having observed what happened to the economic data, we now know that we are easily likely to see the weakest growth that we've seen, even weaker than the contraction experienced during the global financial crisis. And this is the impact of the coronavirus is not a feature that has spared any part of the world economy. Back at the time of the global financial crisis, that was very much seen as a crisis that had its roots, of course, in subprime in the US, in the rapid growth of credit, but it was seen largely as a developed market issue. Of course, emerging markets were caught up in the effects, in the tightening of financial conditions that accompanied the crisis, but emerging markets at the time were thought to have fairly healthy balance sheets and were able to bounce back to growth, were able to stimulate growth that much more easily following the crisis. This time is a little different. None of us will have seen anything comparable in our lifetimes. Not only have to the global economy, we know that we are in sight of a very, very severe demand shock. What can we say about the trajectory of COVID? Overnight, we had the release of China GDP data, and that's created a little bit of optimism for everyone, simply because China was first to have to grapple with the coronavirus, came out of it following its lockdowns, and everyone is looking at the restoration of some growth. Consumer demand in China remains weak, and the likelihood is that we're going to see something very similar mirrored in the rest of the world. But one thing we've also been watching very closely is, are we going to see in the rest of the world where there isn't perhaps as coherent an approach to the health crisis, where it's more difficult to put in place the necessary curbs on activity that will result in being able to beat the coronavirus, are we going to see the threat of repeated lockdowns and new surges of COVID cases that take away from the economic growth and the economic recovery that we might anticipate? Very briefly, it's probably still too early in the trajectory of the coronavirus to tell for sure. We know that in Europe, markets were more positive when it became clear that many different European economies were emerging from lockdowns. Where there have been secondary waves of infection, those have largely been localized and very well contained. Not so in the US, where in the recent past, the key driving factor and the knock on confidence was the fact that we were seeing, perhaps because of the summer months and the greater use of air conditioning, there's a lot of speculation around this, but we were seeing a new surge of COVID cases in states like California, Arizona, Texas, Florida, and it really did seem that this would weaken the recovery picture that the survey data had already started to indicate was underway in the US. And it's this threat of secondary waves of countries just emerging from lockdowns and having to impose new COVID containment measures. It's the threat of that that is enormously damaging to confidence and damaging to the economic outlook as well. At Standard Chartered, we only just last week prepared our third quarter outlook. And what was striking about that was that the deepest contractions generally are likely to be felt in developed markets. In emerging markets, sure, we're seeing more subdued growth, we're seeing contractions, outright contractions in a number of emerging markets, but often those contractions are not anywhere near as deep as they are in developed markets. A few words on the spread of COVID in Africa. This is something that is a bit of a mystery to a lot of observers, where the numbers do not seem to have accelerated as rapidly as we've seen in the rest of the world. The fatality numbers, thankfully, given the very weak healthcare provision that we see across a number of developing regions, the fatality numbers are nowhere near as severe as we've seen elsewhere. Now, Africa, of course, is a big region, and if we look at fatality numbers in Egypt and South Africa, actually there isn't really that much room to celebrate. Those are the regions that are harder hit. Right now, South Africa accounts for around 50% of all known COVID cases in Africa, and it's spreading very rapidly. It is, of course, midwinter, and this is the rise in Africa. No one is quite sure why it is that we haven't seen a more severe impact of COVID. There's a lot of theorizing that maybe the younger demographic overall creates a greater resilience, that many people will have contracted COVID, but the fatality numbers are kept much lower because of the demographic profile of sub-Saharan African countries in particular. It's very difficult to say. Nonetheless, this should be seen as good news, because what it means is that unlike a lot of developed markets, where even if they get through the immediate constraint of the COVID containment measures and the lockdown, and even if they manage to avoid the need for repeated lockdowns, we are looking at a severe economic shock. Developed markets are not the markets that have been associated with a huge amount of economic momentum. We don't necessarily expect that this is going to be a situation that leads to a great more buoyancy in the future. Even so, we're always asked about the shapes for the shape of the global economic recovery. Are we looking at a V-shaped recovery? No. I think we can safely rule that out. What we do know about countries that have emerged from much more severe lockdowns is that it's not a bounce back to normalcy at all. The rest of the world. Second, consumption levels are not being restored to their pre-crisis levels at all. There's a lot of calculating going on. What is it that before they're even able to attain late 2019 type GDP levels? We know that the impact on consumption, especially where we can still anticipate that once government support measures are gradually, the concern is that you will see weak consumption still and very little that holds the promise of being able to bring countries, different economies out of this. It's something that developed markets is likely to be that much more detrimental. In emerging markets, we've come to the conclusion that we can think of emerging markets differently. These are the markets that typically have younger demographic profiles, typically, but not always. We know that they tend to be associated with greater markets that are changing very rapidly. So even if they suffer a year of weak growth or a year of outright contraction, that tells us nothing about the posture and the year after that. In developed markets, the big concern is how much spare capacity might be permanently lost in these economies. In emerging markets, given the growth trajectory that they had and the economic momentum that is still within reach, even if there is a setback in 1 year, it doesn't necessarily mean that growth stalls indefinitely, that the impact of policy matters. And this is important because across the world, we are seeing, it seems cliched, but we really are seeing an unprecedented policy response across different economies. It is the case that in developed markets, especially developed markets where they have reserve currency status, there's far more available in the way of potential policy tools to deploy. We saw after the global financial crisis, the onset of quantitative easing. We know that what we're now, expansion of major central banks, makes that look like a mild experience. We are seeing an unprecedented amount of liquidity being pumped into the global economy. So the question then for the global economy is really about the effectiveness of that policy. In developed markets with more aging populations, with more mature market characteristics, no real expectation of sustained strong growth, it might be more difficult to get demand back. In emerging markets, where there is this need for capital, there is the likelihood of much more momentum, and it will be much easier to get a resurgence of demand following the COVID crisis. But there's a basic difficulty, and that is the absence of capital to make it all happen. The mystery for all participants operating in financial markets right now, as they see the dollar strengthening to levels, its strongest levels in about 50 years, and a lot of the structural factors that were driving that dollar strength are not necessarily in place anymore. If you were to have asked any economist or financial market participant in 2019, why is the dollar strong? Well, there were a number of reasons. US growth was that much more upbeat than a lot of other developed market growth. The rate differential, given that the Fed had started tightening earlier and had continued to tighten, the rate differential was very much in favor of the dollar. And as we saw a ratcheting of geopolitical tensions globally, we also know that there was a great deal of safe haven demand for US dollars. Now the question is, well, things have changed a little. We know that the US economy is at risk of still at risk of repeated surges of the COVID, and whilst we may be seeing a different impact in terms of COVID containment measures being deployed and not deployed, this can't possibly help confidence. The Fed acted very quickly to take interest rates to zero. We've seen a huge boost to its own balance sheet in terms of the assets that it's purchasing. The yield differential for the US dollar is no longer in place. So the big question now for emerging markets, given that they're not expected to contract anywhere as sharply as a lot of the world's more developed markets, the big question is, when are we going to see more decisive flows back into emerging markets? When is risk appetite essentially going to recover? When is confidence going to recover? And for now, it's still an open question. From a lot of the survey work that we ourselves do, we don't think that many market participants necessarily have any expectation that the dollar gets even stronger. That doesn't look to be the case. Part of the issue is, if we look back in history at instances of dollar weakness, you've always needed another developed market central bank to be in a tightening cycle, to be raising interest rates, to take away from a little bit of the dollar strength that had preceded that situation. And right now, that's just difficult to see. There is an expectation that with emerging market yields being more attractive still, it's only a matter of time before we see the flow of capital back into those regions that offer higher returns, higher yields, and that will take away somewhat from the structural dollar strength that we've seen. But for many market participants, the frustration is that this doesn't necessarily seem to be happening that easily still. The rate differential has turned around. It's very difficult to argue that the rate differential works in favor of the dollar. We know that US asset markets, US financial markets continue to outperform, and there seems to be this disconnect between the weakness of the economic performance and the outperformance of financial markets. It could well be that there's so much liquidity going around and there just isn't another investable market, another liquid market where investors could deploy that liquidity, and this would explain some of the asset market outperformance. But everywhere, investors have a sense that something's got to give. And maybe as we start to see more of a recovery trajectory, as confidence gradually comes back, a few positive headlines around a COVID vaccine, that this will help to lift risk appetite. And we will soon enough see a lot more flow into emerging markets. A quick mention on the impact of this crisis in countries that feel much more constrained. In developed markets, central banks have been able to adopt quantitative easing, unconventional monetary policy very quickly and very easily. Because these economies have large and liquid debt markets, it's also been possible to increase the level of fiscal stimulus. It isn't a consideration right now. What is this going to be doing to dollars? I believe this is a big concern, but for now, developed market economies have the fiscal space to be able to deploy both fiscal and monetary policy stimulus measures. The surprise in this crisis has been that such is the severity of the downturn that even some emerging market central banks have started to experiment with unconventional monetary policy. Now, for a lot of the established EMs, Turkey, Indonesia, South Africa, this has been framed in terms of helping with bond market dislocation. There was a huge amount of capital withdrawal from emerging markets, so Nigeria shouldn't be seeing itself as a standalone case necessarily. If you look at EM after EM and look at the volatility that we saw in March, billions of dollars were withdrawn from emerging market debt markets, from emerging market equity markets. It's been noted by some that the rise in the S&P 500 almost matches the extent of decline in the MSCI for emerging markets, that we have seen this withdrawal of capital. So the question I put to you is this: if we think growth prospects are more favorable in emerging markets ultimately, why have we not seen the restoration of those flows back into emerging markets? And ultimately, the issue is one of confidence. Whilst developed markets are not subject to the same fiscal constraints, we know, especially in looking at different African markets, that many of them were bumping against the largest deficits that they would have been seeing even prior to COVID. And the COVID crisis has just exposed those existing vulnerabilities. Revenue, narrow revenue bases, overly dependent in some instances on a single commodity, revenue collapses very rapidly with the onset of the crisis. And a lot of the fiscal deterioration that we're seeing, certainly in the sub-Saharan African space, has got a lot more to do with the collapse of revenue than it does with any potential ramping up of spending by different governments. And this is part of the problem. Where EM central banks have said, well, we're going to be taking a slightly less orthodox approach, they have been very careful to say this isn't quantitative easing. Don't assume that all of this liquidity support is somehow not sterilized. In fact, if you have deposit rates that are above zero, you've got to imagine that there is a cost to any central bank, even if it were to create money that could potentially be used to finance fiscal deficits, there is still a cost associated with that. Quantitative easing only makes sense for those central banks where inflation is really low and where interest rates have hit zero, so there are no other policy options left but to try to print more money. In emerging markets, of course, inflation could be a much bigger problem. Nonetheless, some central banks in the region, and the Bank of Ghana springs to mind, have increased the amount that they're willing to purchase off government bonds, in Ghana's case on the primary market, but subject to a certain limit. And the key here is, at what stage do we sense, look, this could be a little overdone, that it could translate into inflationary problems? For the moment, inflation is not the world's big issue. When you see an outright collapse in demand, as we've just seen, and unfortunately for economies like Nigeria, this manifests itself, has happened during the lockdown periods in big emerging markets and developed markets. If you consider the unprecedented halt to air travel that we've seen, with different countries closing off their international borders in an attempt to deal with COVID, to stop the flow of people and to stop the flow of the virus, this is the most severe shock that oil markets will have seen in their history. And we know that the agreement by the OPEC Plus grouping to try to cut supply in response to this big shock, the big demand shock that we're seeing in oil markets, didn't come very easily at first, but it is now in place. What is our projection for oil? We do think, given the weakness of the oil of demand right now, that oil markets do look as though they've perhaps priced in too much optimism. We know that markets are forward-looking. We know that markets are looking to a recovery. But for our commodities research team, they still say where we are right now, Brent above $40 a barrel, that looks a little overdone. The key here in the very near term is going to be the strength of demand. How quickly do we see it restored? And any good news around a possible vaccine that might be successful will of course lead to expectations that demand will receive a boost. And we will see, as a result of that, that positivity being expressed in oil prices. But there's also a risk, and the risk is this. We know that oil markets only stabilized because of the OPEC Plus agreement to cut oil prices very severely. And we know that the impact of that, the commitment to comply with that agreement, is likely to wane as soon as there's any kind of strength that is restored to the oil price. So already we've had this week the technical committee of OPEC meeting to decide whether they should proceed with the severity of cuts that had been considered early on. We know that in Nigeria's case, because of how difficult it was to comply early on with the production cuts that were being required of it, that there's still going to have to be a need to compensate for that earlier non-compliance. So even though oil prices are looking a little bit more healthy now, it doesn't mean that Nigeria is out of the woods. I will just summarize the commentary on oil, saying that in year-on-year terms, yes, we would expect to see a recovery in demand next year as air travel starts to resume again, as a little bit of normalcy is restored to everyday life. Then we should see ourselves off these very weak levels of oil demand that have characterized the recent past in 2020. But we also need to take a step back and think about the bigger picture. Many of you will be aware of the discussion around the so-called COVID reset. The people are saying, well, do we have to go back to the old way of doing things? Sure, we spent a lot of time traveling from A to B, but you know what? Video conferencing is very easy. Are we going to see a permanent shift in consumption patterns? Are we going to see a permanent decline in the amount of oil demand simply because of changing ways of being able to proceed with economic activity? It's still too early to call. And for now, a lot of the focus has been on the supply side of the equation. With the kind of lows in the oil price that we were seeing in March, April, May, it makes it very uneconomic for high-cost oil production to continue. We know immediately that because shale itself as an industry is so capital intensive, with a short life cycle to the typical shale field, that as soon as you get that kind of price volatility, a lot of plans for eventual shale production get taken off the table very quickly. We also know that there have been other casualties to this. Across sub-Saharan Africa, newer oil producers, countries that look like they might emerge as small oil producers in the future, a lot of the investment into those projects has been put on hold as well. Now, as much as the current price volatility is not a good thing for Nigeria, what this does mean is that when demand eventually recovers, and it will certainly move off these lows, even if we don't go back to hugely robust levels, when demand eventually recovers, we are likely to see a squeeze higher in oil prices. And the reason why is precisely the volatility in price that we've seen late 2014, 2015, 2016, 2017, one could argue. Over all of those years, and then again in 2020, the new spending, the new investment into future oil production has been held back. And this means that even if you factor in any kind of normalization of oil demand, there is going to come a time when the market is going to realize that all those years back, there just hadn't been enough investment in new conventional crude supply to be able to meet that additional demand. If we assume that economic growth comes back and the unprecedented policy response, while we're not thinking this is a V-shaped recovery, we don't think it's a U-shaped recovery. There's been a lot of talk of a swoosh-shaped recovery. Think of the Nike swoosh. Yes, it's weaker initially, and then a very gradual uplift to economic activity. But if we assume policy is going to be driving a restoration of economic activity, the point is, at some stage in the future, the world economy is going to have to deal with the fact that there just wasn't enough investment that went into conventional crude production to late 2014, and it will have to pay the price for that. what it means for some of the would-be smaller oil producers in Africa. Perhaps some of them never make it to oil producer status. But what does it mean for the larger, established oil producers like Nigeria? As much as there is a significant need for Nigeria to diversify away from oil, the scale of its population, 200 million people, something in that ballpark region, means that oil is never going to be the answer to Nigeria's development needs. Nonetheless, we do think there will be a point in the medium term when prices do get squeezed higher because demand conditions are restored and the supply just isn't there to meet it. So I will stop there on the global outlook and move very quickly onto the Nigeria outlook and where we see things. We know that policymakers in Nigeria have recently expressed optimism that the Nigerian economy will only see a very shallow recession. Everyone's saying, well, yes, Q1 was surprisingly strong. Q2 necessarily, because of the ban on interstate travel, the limited lockdowns in Lagos and Abuja and elsewhere, we are going to see a falling off of activity, a likely contraction. But come Q3, there's every expectation that the Nigerian economy can recover. Our own view is that it isn't necessarily going to be that easy from a growth perspective. Our forecast for now is still a 4.3% contraction in the Nigerian economy. Now, that's not as sharp a contraction as the IMF and others are assuming. The IMF is forecasting a 5.4% contraction. But let me talk a little bit about why it is that we see this. Let's focus on the Q1 GDP data. I was surprised by the strength of the Q1 GDP data. We know that a lot of it came about because of this sharp divergence between what was happening in the oil sector and what was happening in the non-oil economy. Non-oil economy was not anything particularly special, 1.6% year on year. We had been far more optimistic by the end of 2019 that there could have been, COVID aside, a more sustained recovery in the non-oil economy in Nigeria. Now we'll have to see, because of the impact of COVID and of course the related policy complications. But oil sector growth in the first quarter in Nigeria was the big surprise. 5.1% year on year. And this was because in the aftermath of the collapse of the OPEC Plus agreement, the OPEC Plus talks in early March, Nigeria, of course, ramped up production. And actually, it had been producing a little bit more than its OPEC quota strictly suggested it should have been producing all along. In Q1 2020, Nigeria saw the strongest levels of oil production that it had seen at any point since Q1 2016. So we know that a big boost to the Q1 GDP data was the oil production data. But we also know that this is probably not going to be repeated. The nature of the OPEC Plus agreement is that Nigeria will have to restrict production. The initial ask was that it takes production as low as 1.4 million barrels per day in May and June. It didn't really reach levels of 100% compliance, so now it's going to have to compensate for that in the months ahead, in the third quarter. Nigeria was to have reached production levels of 1.495 million barrels per day between July and December, but chances are it's now going to have to see lower production to compensate for earlier non-compliance. And then the expectation is that production levels may rise to about 1.58 million barrels per day over the course of 2021, all the way through to April 2022. The problem with this is that it pretty much tells us that through to the end of Q1 2021, Nigeria is likely to see negative oil sector growth. If we think of oil sector growth in real terms as just being a function of how much oil is being produced, then the outlook is bleak. we're not going to get the support from the oil sector growth. And this is why Nigeria really needs to focus that much more on how it unlocks growth potential in the non-oil sector. But let's take a look at policy. Our big concern, well, it's twofold. First of all, the COVID numbers. If you were to do a quick Google search, what do you get today? Number of known cases, 34,000 in Nigeria. Relative to the scale of the economy, that's really small. Is it being measured properly? No one is entirely sure about testing capacity, and maybe some cases are being missed. But for whatever reason, there seems to be a greater resilience of the population so far to the faster spread of COVID. And we're certainly not seeing this necessarily in a lot of the numbers that are coming through in terms of fatalities. Nigeria is not alone. There are many other places in sub-Saharan Africa where actually we're just not seeing anything like the severity of cases that we've seen elsewhere. But should it become necessary for new COVID containment measures to be put in place, then we could see a very different story emerging in terms of non-oil GDP momentum. But there is a far bigger threat, in a sense, and that is, we know that Nigeria's non-oil economy had only just started to show signs of more significant growth by Q1 2019. In Q1 2020, along came the coronavirus shock, the disruption to supply chains, the disruption to activity, and this is likely to be far more pronounced in Q2. But there is a bigger threat that could constrain economic growth, and that is the renewed issues around the non-availability of foreign exchange in Nigeria. We know that policy broadly is set to support growth. If you look at the amount of spending that has been signed up to with the 2020 budget and the passage of the 2020 budget, this is expansionary policy. Nigeria will see a far wider deficit as a result because of what has happened to revenue, but being able to sustain spending recognizes that there is an issue with underlying economic performance, and fiscal policy will be trying really hard to try to improve that situation. Monetary policy too. We know of a large number of measures that the CBN has already put in place. The regulatory relief in some instances that has been considered. We know that the CBN has since early last year been very keen to boost bank lending through its policies. And we have seen a rise of sorts in credit growth. But the concern is that if you overlay on all of these efforts, more concessional financing to strategic sectors of the economy, the cheaper availability of financing, and if you still overlay on that a basic shortage of foreign exchange, are you necessarily seeing the full benefits of the counter-cyclical fiscal policy, of the counter-cyclical monetary policy? Probably not. So it's encouraging, one, that Nigeria doesn't face great external constraints. It has access to multilateral financing, which is cheaper than market financing. We know that it's encouraging that fiscal policy will continue to be expansionary, and it's encouraging only to the extent that people think there are going to be measures in place that eventually allow Nigeria to be more effective at revenue mobilization. Because if it were just a case of Nigeria spending a lot more today, but it's not clear how it raises the revenue to afford to pay back the accumulated debt, economists have a word for that. Everyone will be thinking if Nigeria can't massively expand its revenue base, ultimately the cost of that spending is going to come back to the people who make up the fairly narrow tax base today. And if you were a member of that fairly narrow tax base, chances are you wouldn't be consuming that much because you'd be thinking, well, at some point, I'm just going to have to pay it away in taxes. So the fiscal stance is encouraging, but it does need to be backed up by longer term reforms, credible reforms that really do move Nigeria more significantly in the direction of expanding the tax base. We know that there's been a lot of discussion around the VAT rate rising from 5% to 7.5%, how to make it more effective. And if you take a look at what other oil producers are doing, it's not clear that a Saudi Arabia, with all of its accumulated reserves, is going to keep a 15% VAT rate in place necessarily. But there's an example of an oil producer that said, there is a crisis, we had a 5% VAT rate, let's triple it to 15% to show that we're serious about diversifying the revenue base. So compared to some other oil producers, Nigeria looks as though it has some way to go. A few words on the FX rate, because I'm sure as corporate treasurers, this is front and center of your everyday challenges. Nigeria moved early and in a very adept way, we thought, to deal with the oil price weakness that we saw in March. Very quickly, the authorities had allowed the official exchange rate to be devalued to 360, and we thought this was a positive because of all the measures available to Nigeria that would instantly boost fiscal revenue in the context of a weaker oil price. Allowing for the official exchange rate to move from 306, 307 levels to 360 was probably the easiest way to drive the revenue that was needed to compensate partly for the weaker oil price. Some would say that there is a hesitance to proceed with further official rate devaluation because of what might happen to inflation. But for those of you who are operators in the Nigerian economy, everyone recognizes that the very weak levels of liquidity on the I&E window in the aftermath of the lockdown has pushed demand to the parallel market. And the key issue with that, we've seen it repeatedly in Nigeria, is that the parallel market does not have the infrastructure to be able to deal with wholesale type scale of FX demand. If transaction sizes on the parallel market become an informal market are so small, it is a market that lends itself to overshooting. So if we look at parallel market rates today, we shouldn't be thinking as economists that that has any indication of where the pressures on the dollar-naira exchange rate really are. But until there is a fully functioning, more market-determined I&E window with stronger flow going through it, it's very difficult to establish exactly where the market exchange rate should be. We know that in order to unlock multilateral financing, Nigeria, in its letter of intent to the IMF, the authorities stated the desire to eventually harmonize the different exchange rates. More recent CBN communication has spoken about eventual harmonization around the current NAFEX rate, but this would be done only very gradually. We also know that the kind of IMF emergency financing that was put in place does not come with any kind of ex post conditionality. That is, the $3.4 billion are made available to the borrowing country right away. There is an expectation that the authorities will follow through on what they had pledged, but there is no hard conditionality. Nigeria is also looking to borrow from the World Bank for a budget support instrument, and we also know that typically the world over, that kind of budget support does come with conditionality. The broad macroeconomic environment will matter. What can be done to safeguard the fiscal outlook will also matter. And in that regard, the exchange rate, is there a strong argument for the official exchange rate staying at 360? That might also be an important determinant of Nigeria's ability to unlock that financing. When we look at the thrust of fiscal policy, we know that this is a very difficult time for the Nigerian economy. We know that Nigeria needs to look at all available opportunities to be able to boost the availability of fiscal resources that it needs to satisfy on the longer term trajectory for public debt, that it needs to bring down the cost of debt service relative to the revenue that it is able to collect. All of these are urgent reforms, but they also tie in very neatly with the need to address the foreign exchange constraint. Nigeria has done well with the provision of countercyclical policy. The fiscal intent is free policy intent to try to boost lending is also understandable, but all of it is made less effective when it comes to the lack of availability of foreign exchange. So if there were one reform that Nigeria could put in place quite easily to address the current constraint and growth, it would be precisely this. I will stop there. I had promised to limit the comments to 45 minutes and very happy to take any questions that you might have. Thank you.
Thank you very much, Razia. That was very, very, insightful and enlightening. We will now go straight to the question and answer session. I was just looking at the question and answer part. I can't see any question there, but however, I would like to invite the moderator for this session, Mr. Ishmael Nwokocha. Mr. Ishmael Nwokocha is the treasurer of MTN Nigeria and is the immediate past president of the Association of Corporate Treasurers of Nigeria. So we'll now invite Mr. Nwokocha to take up to moderate the question and answer session. Thank you.
Thanks, Patrick. Razia, I just want to say thank you for that. It's like going back to the MBA class. So I had my notes all loaded, So I just want to say thank you for that deep insight. I guess it's time for the questions, and I think it was also good that everybody kept a listening ear, and on that basis, we didn't see any question pop up through. So the question part is open. Use it. So let me start. The first question I want to ask is, so Razia, you said it wasn't a V-shaped recovery, neither is it a W shape. So what shape is it? The recovery we intend to see.
Thank you.
Yeah, go ahead.
We've spoken broadly about the likelihood, for want of any better. The reasons for this are that it's very difficult to say for sure what the immediate term picture is like. If there is a need for repeat, that could lead to a prolonged downturn in the economy. But ultimately, we don't think this is U-shaped in the sense of a depression. Depressions are caused when monetary policy is particularly unhelpful, where you see huge constraints in terms of the flow of liquidity and the flow of credit, and that doesn't seem to be the case now. We have seen an unprecedented amount of central bank balance sheet expansion in developed markets. And as a result of that, we do expect that at some point that liquidity is going to be deployed more productively. When investors have the confidence to start searching for yield again, when investors are searching out those higher returning projects where the yields and the returns are higher, then we're likely to see a return to more productive investment that will ultimately boost growth. But the difficulty right now is being able to call the timing of all of this. We know that 2021 will see a technical bounce. When you have a sharp contraction in 2020, 2021 is going to look really good, but it's not very meaningful. We should be thinking of GDP in terms of not just the growth rates, but the level of GDP. We do think that the policy backdrop globally is broadly supportive. If I were to bring it down to the Nigeria level, I'd say we're still in sight of seeing a growth restoration. But much depends on how these bottlenecks that are easily avoided, like the disruption in the availability, the easy availability of FX, if that can be resolved quickly, Nigeria is back on a growth trajectory path even faster. And if it doesn't get resolved, unfortunately, there may still be demand that gets pushed to the highly illiquid, untransparent parallel market, and you get an overshooting of the exchange rate, which then sets expectations for much more Naira depreciation than would strictly be necessary. So on a global level, what we're saying is policy has been helpful. We don't expect it to be V-shaped necessarily, but it's not you. Think of it as an extended swoosh and, good news, the discovery of a vaccine, policy really being able to play a role in the recovery, the return of investor confidence will determine the slope of that recovery and the slope of that swoosh. For Nigeria, it's still an open question. We think on the basis of oil developments alone, things should look much better from 2021 on. But a lot will also depend on the extent of the severity of the downturn in 2020. And that, of course, is also dependent on policy choices.
Thanks, Razia. We've got one more question there, on the chat box. The second valuation has happened already this year, with all prices rebounding to better levels. Do you still see further room for devaluation?
Of the Naira?
Of the Naira to the dollar, yes.
If we were to compare Nigeria's experience with other emerging markets, we know that other emerging markets were hit far more greatly with the extent of foreign exchange volatility. Take South Africa as an illustration. At the end of last year, we were seeing sub 14 levels of with the kind of volatility that we saw, South Africa downgraded. It lost its last domestic bond market, $1 billion of outflows in a very short space of time, going right through 19. So 14, 15, like it would reach an end. And it's completely reversed, and today we're back in the mid-16s. So that's the advantage of currency flex. Also, fundamental reason to think that the exchange rate needs to weaken and weaken and weaken, especially if oil prices are recovering. We do think that Nigeria will still see a current account deficit. So any accumulation of reserves will likely have to be inorganic for a while, but credit markets are still open to Nigerian issuance, and there are plenty that could be done to stabilize reserves. And if things were to open up quickly, that would limit the need for further excessive exchange rate depreciation. The risk is that if things do not open up hugely rapidly, if there's a long waiting period, then the risk is of even greater Naira depreciation and overshooting and much more weakness than would strictly be necessary.
Thanks for that detailed response. One more from my own side is one of the things that you said is the return will, recovery will also be indexed around things around capital growth, maybe. And we know basically some of the things that keep capital coming is respect for the capital, reattract the capital, retain what we have, maybe also index on quality of government policies and things like that, and the level of confidence that you have in the market. My question to you will be, in order to have this competitive and capital growth, what shouldn't the central bank or the Ministry of Finance be doing?
A very key part of this is the ability to retain confidence. And Nigeria did very well. Since the middle of last year, reserves have been under pressure. because emerging markets generally were pressured. The dollar capital outflow from emerging markets that preceded even the COVID crisis. This much is clear in terms of the way the dollar has behaved. And for the most part, the authorities in Nigeria accommodated that. The realization was that if you want portfolio investment to come back in, you keep the currency convertible, you keep the guarantee of the exit in place. Sometimes the capital flows out, but it does come in with greater ease when conditions are right again. Now, to the extent that because of the COVID crisis, there has been an interruption to that process. Everyone understands that with the receipt of multilateral financing, nobody wants to see an immediate drawdown of everything provided by the IMF just to satisfy outgoing portfolio investors. But the concern might be that unless Nigeria can find a way to balance things out a bit and to provide greater confidence that the Naira is still fully convertible, that foreign investors can bring money in and take money out whenever they need to, if there are seen to be any market frictions that get in the way of that process, it just means that the recovery is that much longer. We need to take a step back. A huge amount of liquidity has been pumped into different global economies, developed economies. 25% of the AUM, the assets under management of US money market funds, came through just in 2020 alone, the equivalent of around $1 trillion. The amount of central bank balance sheet expansion in developed economies is unprecedented. And that flow could easily find its way into emerging markets where returns are likely to be higher, where the investment outlook looks brighter, if capital markets are fully functioning. But if there is an anticipation that Nigeria, it's not about unrealistic outsized returns. It's about scaling the availability of capital with where economic growth will justify good long-term returns. But if Nigeria is seen to be more constrained in its ability to attract foreign portfolio investment, then its share of that unprecedented amount of stimulus that has been pumped into the global economy may not be as large as it otherwise could be.
Thank you. I don't know, we're not seeing more questions. It looks like everybody came to listen.
I see a lot of questions on the chat. Would you like us to go through?
Yes,
that?
please, let's go. Yeah.
So, there are so many, it's a question of how much can be taken. We've already answered the question on the V-shaped recovery. Unconventional monetary policy is another question that's come up. In your assessment, has this been more beneficial or damaging to the countries that have practiced this? I'll take that question very quickly. And
okay.
A key one on unconventional monetary policy is it's easy to do when your immediate problem is deflation. You have a likelihood of suffering from deflation when demand is very weak. Your demographics suggest you've got an aging profile. You're not going to see the natural population growth and the natural momentum in demand that will help to drive this further going forward. Emerging markets, and especially economies like Nigeria, are not in that position. Inflation is still higher than it should be, and therefore there really isn't any room for unconventional monetary policy in EMs where the constraints are different. There isn't a threat of deflation. It's not as though these are weak growth economies with no prospect of demand returning. There are very specific situations that require unconventional monetary policy. But we know that Nigeria is an actor in the global economy. Nigeria can benefit from the amount of Fed easing, ECB easing, Bank of Japan easing, and Nigeria can benefit by keeping itself investable. Ultimately, it has a healthy, longer-term growth story to present, but it's all important to preserve the confidence that it remains an investable jurisdiction.
Okay, thank you. I think the one would be the impact of what you think, analysis that you think will impact the stock market.
Okay,
market, yeah.
one which is far more, I think, front and center of monetary policy that I'd like to take first, if I may, and that is
Please go ahead.
liabilities and the CBN's balance sheet and the CRR debit. So Nigeria's caught up in difficulty. We that with all of the outflow by portfolio investors last year, in order to stabilize the currency, a certain tightness of liquidity was required, and the CRR we used to that. We also know that 2020 is different because of the COVID-related pressures, the likely contraction of the economy, that the same tightness in liquidity is not necessarily called for. So the dilemma for monetary policy in Nigeria is, how do you relax things enough to be able to provide a stimulus to the economy? And central banks around the world have been doing this. Nigeria would not be unique. For other oil-producing countries that have sizable reserves and currency pegs to the US dollar, they benefit automatically. The Fed has taken interest rates to zero and they have a peg to the dollar because they've got the reserves to sustain it, and so they've got much easier monetary policy. For Nigeria, it's much more of a challenge, simply because it doesn't have a fixed currency exchange regime, and that has significant drawbacks to it as well, but it doesn't seem to have a willingness to allow for complete market flexibility either, where a little bit of market flexibility might help in terms of being able to attract those new inflows. And this fundamentally is the complication for monetary policy. So we expect, with OMO yields having come off their earlier highs, that we're not necessarily going to see any return to that significant tightness that had been characterized, 2017, 2018, those days have gone. We think we'll be looking at a lower level of interest rates going forward. Even with these lower level of rates, Nigeria should still be in sight of attracting new portfolio investment, so long as it can maintain the confidence that it is still as investable as it used to be. I can now take the...
There's another one on, there's one on, should corporates be buying NDFs to help them manage the FX exposures they have when they go into things like maybe confirmed LCs, trade lines, and things like that? Do you think the price points make sense, or we should just shy away from him?
So the short answer is yes, it is a hedging instrument that is available, and you should probably be speaking to my colleagues on the banking side and the financial market side at started for more detail on that. But if it's a case of having an instrument that is available for use and nothing, so having some sort of hedging instrument is always a better idea. And I see Elizabeth has put on the chat that she's very happy to take forward that conversation with everyone.
All right, okay, thank you. I think we're almost going a couple of minutes to go. Says, what's your view on H2 2020 FX?
So our expectation had been that we would see a very gradual depreciation of the dollar-naira exchange rate, and that eventually when oil prices come back, the naira would be able to strengthen further. We know that in the recent past, in recent weeks, we haven't necessarily seen that pace of adjustment on the INE window. Nonetheless, the CBN has reassured everyone that its eventual intent is for gradual harmonization of the different FX rates, harmonization around the current NAFEX rate. And the question then is, how much more depreciation should we anticipate? If you ask an economist looking at fundamentals, Nigeria will have a larger current account deficit because of the decline in oil earnings, but it will also have recourse to a lot more multilateral lending, which is available on a concessional basis. And that's one means of being able to finance some of that deficit. We're not necessarily seeing a deficit that is pushed out by strong demand and a great deal more investment. It's much more a story of the revenue deterioration that has been seen. And in those instances, the receipt of external financing is going to be important to reassure on the FX rate. So a lot really does depend on whether we see any changed trajectory on the INE window in the very near term.
Okay, and then there's one from Abdul Kirim Musuli, yeah? So he deals with IC gas oil price has been oscillating for the past month. In the months, you can advise hedging of importation of petroleum products with his vendors, or simply transmit LCs, or wait for CBN window that has been identified to be short of dollars. He's asking if there is any specific, I guess probably Elizabeth has responded to that they can come and talk to them.
I think it's more a question for Elizabeth than for the economy. Over to Elizabeth.
Okay, another one talks about collapse with this. Okay, the paucity of the FX here created situations where demand for FX can no longer be met. Yeah, manufacturers are in serious troubles and there will be serious disruption to meet obligations, correct? Cost of importation has increased and through trade lines readily available. I think also that cost in trade lines also is a result of junking of the Nigerian rating. So a lot of correspondent banks have yanked off trade lines and things like that. If the global economy is going to bounce back sharper than we expected, what is the lead time to meet up these requests?
So you raise a very good point, and that is Nigeria, in a sense, has been a victim of the coronavirus crisis. It has hit oil receipts very significantly. This underscores the credit deterioration that has been observed, and the actual spread of COVID in Nigeria, the containment measures, those have not been the major influence on growth, although we do expect to see an impact in the second quarter. The question is, what can an economy like Nigeria do to reassure on its credit strength? First of all, on fiscal receipts, anything that can be done can still be put in place to create confidence around the longer term diversification away from the oil dependence will be helpful. A second point is simply the use of that official FX rate tool. If the intent is eventual harmonization with the NAFEX rate, that implies the official exchange rate moving from 360 potentially to around 385 thereabouts. That would still provide some sort of boost to fiscal receipts and provide at the margin a reassurance that things are improving. The hope, though, is that it's about much more than just the harmonization of the different rates at the NAFEX rate. It's about when does activity come back to the INE window? When does liquidity come back in a fully restored way? The easiest way to do that, even before the full gains in the oil price, even before there's much more visibility in oil earnings being that much higher, is to ensure that Nigeria remains investable with the extent of liquidity that has been pumped into the global economy. That liquidity will be looking for those higher returning opportunities, and to appear not to be as liquid, to appear to be slightly less investable in that context, may be doing more economic damage than was intended.
Okay, thank you. Then I think we're probably almost on the last one. You've talked about fiscal space and fiscal stimulus from the advanced economy and their central banks, how they've gone about that. Nigeria has only just attempted with 1.6% of its GDP. Do you think this is sufficient enough to restart the economy?
The sad fact of the matter is that in terms of the fiscal constraints that all African countries face, those are much more significant and much more binding than they are for more developed counterparts, developed market counterparts, simply because those counterparts have a different inflation profile, have in some instances reserve currency status, and therefore have the opportunity to implement QE type policies, which can help with a fiscal stimulus. That option is really not available to developing countries with much more narrow tax bases and still a great need to diversify away from the dependence on oil and the vulnerability associated with that. So it would be good if there were the capacity to spend in a more efficient, targeted way. But the reality is Nigeria is already likely to be running a very substantial fiscal deficit. The reality is that debt service costs as a percentage of revenue, because of the coronavirus, that there really isn't the room to try to spend more, even assuming that fiscal space were available.
Okay, I guess. Thanks, Razia. It was nice chatting.
Thank you.
Thank you very much, Ishmael. Thank you, Razia. We thank you for this, for having this time, spending this time with us. On behalf of the Governing Council and members of the association, we wish to especially thank you, our guest speaker, Razia Khan, for the insightful and enriching discussion. It is our hope you will always oblige us when we call you again. We also wish to thank all the attendees for taking out time from their busy schedules to join the webinar. We really appreciate you for your time and hope the session was of much value to you all. I think at the time most of us were registering for this webinar, some of the attendees indeed indicated interest that they would want to be members of the association. We shall be reaching out to you as regards the modalities and requirements for the Actn membership. Once again, I want to thank everybody for your time, and I wish you enjoy the rest of the day. Thank you very much, and God bless.